What's going on, everyone? What's up, everyone? Good morning. Just make my little post here. All right. Yeah, lots of earnings events to look at today, everyone. We're going to be breaking them down. Just my computer's lagging here for a second. Just hold up. Okay. Hey, how's it going, Inland? How you doing this morning? Got a lot of earnings trades we're going to look at today, guys. There's some cool companies releasing earnings. I noticed a few trades for like long and short positions. So I'm just going to break them down for you. If you guys have any trades that you actually want me to take a look at, I'll be happy to do it. Just leave a message in the comment box and I'll break them down for you. How many of you guys trade earnings though? Like earnings is one of those things that we love to trade. It's just so much fun. There's always a good rush with it. You know, it's quick trades. We probably place at least 100 to 150 trades per earnings season, if not more. I like the turnover, and there's just such good edge as a retail trader in this space. You just got to know what to look at, and then yeah, it's been pretty profitable the last few years. So first company I wanted to look at today was Trade Desk, because Trade Desk is, when you're usually looking at earnings events, a lot of the time there's a serious like risk premium associated with the options, meaning that in the long run, it's actually usually unprofitable to be holding like straddles, for example, around the earnings events. But this is one of the companies I found where it's actually been a profitable outcome, right? Over the last 3 years, if you had held a straddle at each earnings event, you would have come out with 27% profit. And if you look, like a lot of the times, basically this company is outperforming the expected move, right? And if we add up all the expected moves, we end up getting this here, which is a 17.2% average move on the event. So for every time that the Trade Desk has an earnings event, on average, they move 17.29%. So why is this important? Well, because when we look at the earnings move implied for this event, we're actually only seeing 12.37. So this is really cool because what we're basically saying is the amount that they're expected to move for this earnings event is less than they move on average. What does that tell us? It tells us that if we are able to isolate the event using options, we're going to get a pretty cheap bet relative to what they would usually cost for this stock. So what would we do here? We would basically buy a straddle, right? If everything else aligns, I'm going to go look at the prices in a second and the skew. But if everything aligns, you can basically get a cheap bet here because volatility is directly correlated with how the option is priced. And you could buy it for less than what the average move is right now. So buy cheap, sell expensive. This is a cheap. We would buy cheap. Obviously, once again, we'd manage our risk. Have a pretty moderate risk level. Maybe keep it to 5% of our account. But look at this. Like we get some really big moves, right? 43%, 37%, 31%. Once in a while we get like a really small move, like 1% or no percent. But it looks like on average, this company has the potential to make some very big moves. So my recommendation is if you're looking at trading this and you want to make a bet on it making a big move, this is a good one to do it on. You only have to just buy an at the money straddle, right? Look at this. Options are super cheap, right? Short term is a little more expensive. It's pretty expensive for the short term, but relative to the size of move that it's implying, it's still pretty cheap. So what you do is for this, if you wanted, you would open the position right at market close and you would sell it right in the morning. All right, guys. So let's keep going here. Let's have a look at some of the other earnings plays for today. Dropbox has earnings today. Cool. Any of you guys looking at Dropbox? Dropbox has been pretty bad for earnings. Right, Dropbox has been pretty bad for earnings, but let's see what we got going on here, right? Implied move is 10%, average move is 7.8. In the end of the day, like it's not a huge edge, but if I were doing anything here, I'd be selling volatility. So I'd sell an iron condor. If I had any directional bias, I would use this skew here to sort of make a bet. If you think Dropbox is going up, you can place a pretty cheap bet. You can structure an unbalanced fly if you want to bet to the downside. Pretty normal stuff here. What you would do at these are the types of events that you don't go all in on, right? If we look at right here, we actually have pretty small moves around this time, but we got to think about this. Like any one of these trades, right? The edge is not huge, right? 7.8 and 10.1. It's not like this is not like a knockout play or anything, but it doesn't mean it's a bad play, right? There's still edge here. And what we just have to do is we have to trade a lot of these events for that edge to really show itself. So what I would recommend is if you wanted to trade Dropbox, don't let it be your only trade today, right? Take on a few other positions that are uncorrelated, a few other earnings plays, maybe a non-earnings play, something that is unrelated to Dropbox to sort of spread out your risk a little bit, right? So something that we always do is we're never really just trading one event. Like obviously, if there's only one play, we'll take the one play. But the reason we use this scanner here is because look, if we just sort by today, right? I'm using a bunch of different filters right now, right? I'm looking at like today's earnings, just after hours, not tomorrow morning's earnings yet, right? At least a price of $20 with an average option volume of at least 2,000 traded a day. So like it's a pretty good criteria that I'm using here. Filtering out a lot of the positions. There was, I think, 5 pages before I started filtering. So, this is a really good way to look at it. And we have so many opportunities to trade here, right? Let me add one more filter, implied versus realized. So I'm comparing the implied move with the actual move of these stocks. So, one with the smallest would be Roku. So let's take a look at that. Interesting. Here, let's see, guys. 1 second. What do we got going on here? Okay, so implied move 12.19%, average move 21%. So we've actually had a pretty good sample size for this too, but I need to make sure here that the data is not being skewed by a couple of big moves here. Minus 17, plus 21, minus 22. Okay, so no, it looks like on average we're getting really big moves in Roku. And for some reason for this earnings event, we're not implying a very big move. But if you look, buying volatility has been super profitable. You would have made 40% in the last 3 years. Q2, we get a large range of moves. If we were to have a small move, this is the quarter historically we would have it. But we still get pretty big moves here. So when I'm looking at this, I'm seeing a pretty good volatility play, right? Once again, we can buy options. And if you have a directional bet, right? If you look at if we look at the distribution here, it's actually almost perfectly balanced up and down, right? So this is one that if you have a directional bias, it can be hard to really take a view on it. Because look at this, this is basically how much on the bottom here, it's how much does it move up or down from 0. And then this is how frequently it happens. What we can see is, it looks like we do get bigger moves to the upside, but we get really big moves to the downside almost equally as frequently. So it's a tough one to have a directional bias on. There's no real edge in the market. Obviously the out of the monies are a little more expensive on both sides. It attracts a lot of retail attention, but I would honestly just play a straight straddle. At the money straddle, you could probably come out with a pretty good profit here, right? The option, what this tells us here is the options are pretty cheap relative to what's actually likely to happen. So I would consider it. I would consider taking that long ball play here. Jordan, how's it going, man? How are you doing? Okay, guys, if you have anything that you want me to take a look at, leave a comment in the chat box. I much prefer to look at trades that you guys want because then we can have a conversation about it. I can help you actually structure out a trade if you'd like. Basically what we're looking at here is just a data-driven approach to options trading. So my partner and I, we basically use forms of quantitative analysis to break down options a little bit further than just the charts. So we're looking for basically mispricings here. Where are things cheap? Where are things expensive? We want to be selling the cheap and buying the cheap and selling the expensive. So if you guys want me to break down a trade for you, I'll be happy to show you a way to structure a trade that can be cheap for the stock you're looking at. It can be earnings trades. It can be non-earnings trades. We're just taking a look at everything. You want me to take a look at Apple? Wow, man. Why do you want me to do that? I have a big short position in Apple right now, and it's getting smoked right now. Oh, great. Wow, the out of the money puts are actually still really expensive. So I guess I won't be adding any more to my position. Implied vol is right in line with the R vol. So it looks like this thing's being priced pretty accurately right now. I guess where you really start to get a mispricing in the option space is when a lot of volatility enters the market. So right now, the volatility sort of calming down, right? I think what's VIX at right now, like 30, 31.38, right? It was at 80 earlier in the year. So, things have calmed down a bit. There's a little bit more efficiency, especially in the larger stocks. I'm not really seeing any trade here unless you want to be selling these puts or buying these calls. I wouldn't really be, there's no inefficiency to build my trade off of here that I'm really seeing. Jordan, if you have anything particular you want me to look at, let me know. Let's see. Okay. Back to the earnings trader for a minute. Let's not take a look at Apple anymore. Any of these that you want me to take a look at, guys? Anything having earnings today? Oh, Uber Technologies. Herbalife. Oh, that's always a fun one to look at. Okay, average move 5, implied move is 8. So this is kind of the opposite of what we've been looking at all day, which is that this is one of those stocks that buying volatility around earnings has been historically unprofitable. And the reason that it's been unprofitable in the past is because the market overstates how much they think this thing's going to move, right? So the market does all their calculations. They use the analyst opinions. They have usually a lot of demand driven around this stock around this time, right? Relative actions at all-time high. Right, you can see there's a lot of skew going on. And basically what this tells us is that the market doesn't know how to price this thing properly. So even though we have had more volatility and it's likely going to move a little more than the average, we need to think like, how much more is it really going to move and what's going to drive it? Right. So the way that whenever I see volatility being overstated, I always go into the market and ask myself, what's the surprise going to be? So I look at the news for this company and I go, where is there going to be a surprise? Right? Let's say they're saying they're going to come out with really bad earnings. Okay, great. How bad are they going to be? Cool, you've told us. Okay, great. If the market is pretty confident that they know what's going to happen, it'll be priced in before the event, meaning that when the event comes, we won't see a big move. So for us to see this 8% move, we pretty much are going to need some explosive news, something that the market isn't anticipating, and then we're likely to get a move of this size. Otherwise, we're likely going to be a lot closer to our average move. And this is reflected in the historical P&L, right? If you had bought volatility or bought, like, let's say an at the money straddle for each of the events in the past, yes, you have a couple winners here and there, but overall it's historically unprofitable, right? Q2 is one of those quarters when we could get these big moves, but nonetheless, it's probably a good short vol play. So what I would be doing here, guys, if you've been here since the start, is take note of all the ones that we've looked at and build out a little portfolio of them. Spread your risk across all of these trades, and you'll have a, if you do this over and over throughout the earnings season, you'll come out looking pretty good, right? The thing is in each of these trades, our edge is pretty small, right? 55 to 45. That's why we need to trade a lot of them, right? It's like having a weighted coin. You can't just flip the coin once, bet all your money on one flip. You need to actually play out like 100 flips and bet a little bit on each one. And then all of a sudden that 5% edge becomes pretty significant. Yeah, thanks a lot for that, Jordan. I'm just seeing it here. Yeah, so HVOL is a 20-day period. Jordan, yeah, if you want to help out Anonymous there, that'd be great. Nick wants us to look at TSM. Okay, let's take a look. TSM have earnings and non-earnings play? Let's have a look. Okay. Just give it a second to load here. Did you say what strike you bought it at? 54 call. Okay. So, you're paying a little bit of a premium for that relative to what the market is implying the move to be. But, it's one of those things, like I don't have a view on the direction myself. Right. So when I'm looking for inefficiencies like this, what I'm looking for is mispricings. So what I would tell you is that it's what you're paying for that call is a little bit expensive relative to how much it's likely going to move. But if you're betting on this thing having a massive jump in the future, you're going to need to use things beyond just this to actually make that opinion. Like, right, we look at things like the skew, the implied vol, the forecasted vol, right? What I can tell you is you have a lot of action around this thing right now. So, it's like, actually, let me take a look at something else. Skew. Okay, so skew's pretty high right now. It might come back down in the future. Okay, not too curvy. That's cool. Yeah, so you got a lot of action going around this, and the relative IV versus forecast is pretty high right now. So you could actually see that change in the future, right? So it might not be a bad play. It might not be a bad play, especially if you're betting on a big move. Like once again, like just the big mistake is people trying to get rich quick in this game. So just make sure that you manage your risk properly on this, right? I would spread your risk across a couple of different trades as well. Calling direction in this market is pretty tough, right? Like we've been on a bit of a serious run here, but volatility is pretty low, and for everything going on, you could see volatility go back up pretty quickly, which assuming that the market takes a bit of a downturn, that won't be too good for the call. So yeah, I would hold it. I would set for yourself a profit and loss that you're willing to accept, and if it touches either side of it, I would get out of the position. Okay, I'm going to break down a couple more trades here for you guys. That was really good though, man. Thank you for shouting that one out. I hope that helps. There's not a lot of edge either way there, Nick. So like I can't really recommend you another trade to be taking. If you wanted to take a long position in it though, a way you could do it would be to structure an unbalanced fly to the call side. So that's what I would say. It's a little bit more tricky to set up. I think we're going to be making a couple of videos on how to actually structure those. But what it basically lets you do is in an environment where the out of the monies are really expensive, right? Which is what we're seeing here. There's a lot of bid for the out of the money calls. You can take advantage of this situation to structure a cheap bet to the upside. So shoot me a DM about that, or just make sure you're subscribed, and I'll be releasing a video on that in the coming week. Not a problem. Okay, let's have one more look here through earnings, see if there's anything else that I really, cool names that I want to talk about. Live Nation Entertainment's having their earnings, so that's kind of fun. Let's take a look at that. I think we were looking at them the last earnings season as well. Okay. So this is an interesting company because this is one of those ones that a lot of people are looking at it because, they expect it to be heavily impacted by the COVID-19, because they're one of the companies that they host concerts. Who's going to concerts right now? Absolutely no one. Their revenue goes from 100 to 0, right? So, I totally get why this attracts a lot of eyes, but we got to keep something in mind here. The market is only going to move on the earnings event, like a significant move, if there's a surprise. So for example, if everyone's coming out right now and the market consensus is that they are going to have 0 revenues, and they come out and say, oh, we partnered with a bunch of charities and are providing, Live Nation t-shirts to them, and we made $100 million off that. All of a sudden that's unexpected revenues that came in, and it could cause a bigger move in the stock price. But if it's going to be in line with what everyone thinks, it shouldn't be any more than the average move, right? So this is another one that shorting volatility could be pretty good. In terms of how big of a move we've ever seen, right? In the last 3 years, the biggest move has been 12%. It would hurt obviously if it moved 12%, but on average, it's moving a lot less, right? If you look at almost all these other moves in here, they all end with you coming out with a profit, right? None of besides this 12% move, we haven't seen a 9.46% move. So what this tells me is that the premium that people are willing to pay for protection on this thing, or to be able to take a bet on it is pretty high. So once again, this is a great selling opportunity. All you got to do, I can't stress it enough. What we're doing here is we're finding the inefficiencies. So this is the first step in really constructing a good trade, right? We find something that's mispriced, right? We go, oh, this guy's willing to buy a $5 bill for $9 from me today. That's pretty cool. But now we got to understand why. right? So the next step the step that you guys need to take if you see a trade that you like here is you actually need to take it off this terminal and go onto the internet and research, okay, why is the market implying such a big move here? Why are they willing to pay so much for this? Because if we don't understand why they're willing to pay so much, that means like there's still a reason. We just don't know it. And that puts us into sort of like a gray area where it's like, are we selling to insiders? Are we selling to people who know more than us? Right? We want to consider ourselves the sophisticated trader, which means we have to thoroughly understand not just where the inefficiency is, but why the inefficiency is there. So step one is this. What I'm doing with you guys right now is step one of constructing a really good trade. The second step would be to, go to places like StockTwits, right? Let's take a look at, is there a lot of, LYV? Is there a lot of retail hype around this right now? What's the sentiment here? Probably really bearish, right? Yeah, look at that. So this is perfect, right? So like when we see an extremely bearish market like this, right? Like why would someone be extremely, extremely bearish on Live Nation right now? Well, probably because they're thinking they're not going to have any revenues. But what these people are often forgetting is that everybody's thinking they're going to have really bad revenues. So where's the edge in that information? How does that information give us an edge over everyone else? The other 3,300 watchers that think this thing is going to come out with really negative returns, right? It kind of doesn't, make sense. But this is good for someone who's looking to sell volatility, right? So since the inefficiency we found is that volatility is higher than it should be, meaning the options are more expensive than they should be. And then we go here and we see that everyone in the retail market is extremely bearish, right? They all think that it's going to have really bad revenues, right? I'm sure if we read it, it's going to be like really bad, everything, blah, blah, blah. Like these are good signs. These are good signs. The next step we would take would be to go look at what the earnings are expected to be, right? Is the market, go look at the analysts and see how badly do the analysts think that they're going to miss earnings and how much agreement is there amongst the analysts. Once we do that and we do, one or two more steps of research, we'd then be in a position where we can go, okay, now we know, now we have an inefficiency. We have a pretty thorough understanding of why it's there. The third step is always to construct a trade to capture that inefficiency. So when we move away from earnings trades, when we get back into regular day-to-day volatility trading or options trading, really, we can get more creative with our structures. But for the purposes of earnings trading, it's pretty straightforward. If you think volatility is cheap and you want to buy it, you just buy a straddle at the money. And if you think that volatility is expensive and you want to sell it, you just sell an iron condor. So on this, I would be structuring out an iron condor. I put the wings about 2 standard deviations out. I try to get the body strikes as close to the current price as possible. And I also make sure to place this trade at the end of the day, because what we're doing with this, right? Like our inefficiency that we found is by isolating the earnings event, right? So we actually go and we strip away the market volatility, we strip away the non-event volatility, and we leave ourselves with the earnings volatility, right? And there's a lot of work that goes into that. But to really capture that, we need to be as close to isolating that event as possible. Meaning we want to get filled at 4 p.m. Eastern Standard Time, and we want to be closing out that position right in the morning when the market opens, right? That way, we're playing that edge, and we know that we're controlling any external variables that could cause the stock to move outside of what our expectations are. Now, obviously, these numbers are not always correct, but if we're playing the game of trying to play out an edge, which is really what we're doing here, we're playing out an edge. We have a small advantage. We do many, many trades. We come out winners in the end. We want to make sure that we're staying as true to that edge as possible. So that's why it's super important to isolate this event with your trades. And that's why the third step, structuring the trades, is, if not the most important, then equally important to the others. You guys got any other stocks you want me to take a look at? I'm going to be on for a few more minutes here. Take a look at StockTwits and see what's bumping. Tulo. Let's see if there's still an edge on Tulo. They had earnings come out. Yeah, we had one of my guys, one of my buddies was holding this and made a ton of money on it. I was really happy for him. Let's see here. All right, implied vol and realized vol is kind of the same. Doesn't look like there's much directional edge. Ton of action though. ton of action. I think I thought I'd see more of a skew here with this level of action. But yeah, Jordan, I don't know why Kev is still holding this, man. Looks like he should get out. Huh. Let's see if there's any other good vol trades right now. Here, just give me a second, guys. Wow, look at this. What happened here? PTLA stock. Let's do a quick look here because that's a huge difference. What did these guys come out and say recently? It looks like the market cap is big enough to play with. Enough option volume. So let's take a little look into it. Why are they skyrocketing? Let's see. You guys know anything about this? Why is this thing jumping like crazy? Jeez. Well, either way, if you look at this, it looks like there's no stock split or anything which came up. So that's pretty cool. But let's take a look at this, right? Guys, a huge trade here, right? Implied volatility of 11, realized volatility of 87. All right, let's take a look. Look at this. Something's happened in the last little bit that's caused this major split. Right here, major split. And, whenever things like this happen, whenever there's significant changes in volatility, there's usually a trade to be had. But since it's realized higher than implied, I would do some research, guys, to really understand what's going on here. And then you could buy volatility here if it's worth it. Because what this means, implied means selling for cheap. Realized is super bid right now, or super outpacing of the implied volatility. So I would totally consider taking a trade here if there's nothing that's extremely out of the ordinary. If it's just had this massive move on news or on some fallout because of the news, it could be worth taking a bet here because you can take a cheap bet, right? So once again, don't bet huge, but like you can get a lot of leverage here, which is something that I know a lot of the guys really like. Let's see, do we got anything else kind of cool to look at? Let's see. AGO. No, not enough option volume here. Damn. Average option volume, not enough. TGTX. I think that's a pretty popular one, right? See that all over the boards. Nice. Okay, this looks pretty cool. Right? Any of you guys trading this? Oh, you think there was an acquisition for that for that pharma company? Okay. Yeah, I know that would make sense. I was wondering why the realized vol was so bid. Okay, makes sense. That makes a lot of sense actually, man. Thank you. So, what about this company here, guys? Anyone looking at TGTX? Yeah, TGTX has had a really big move recently. Looks like you can still, if you think that it's going to continue to move, right? Our forecast says it's going to continue to move more than the market thinks as well. So you could take a bet here, right? Depending on your directional view, if you have one, you can structure a trade, using an unbalanced fly of some sort. But you could also just take a directional bet, right? If you think that this thing is going to go up, you can bet on it going up for pretty cheap. Obviously, betting on it going down is really expensive. It looks like it's had a bit of a dip, and also, obviously downside protection is always pretty expensive in this market. Has realized been outpacing implied for a while? No. So it looks like it's something that's only happened recently, right? It's actually really interesting. The implied vol has been dropping significantly, whereas the realized vol actually went up a bit. So if we don't see anything out of the ordinary here, right, these are the trades that we like to take, right? We see a little inefficiency. Now we got to go do some research. If if we're all good on the research side of things, we can totally structure a trade here to capture something good. And yeah, last thing here, guys, before I wrap up, starting next week, probably, Jordan and I are going to be actually running a live account on here. So we're loading up an account with about $5,000, and we're actually going to start taking these trades live. So, I think a big difference between people who just break down trades and people, like people who say they make money and people who end up making money at the end of the day is the people who are making money. They're willing to show you 100% transparency. So obviously not all of these trades that I've looked at today, I would actually personally be taking, just based on my own risk tolerance. But if I, in these morning trade analysis, when I do see a trade that I actually would 100% take, I'll be going into a brokerage live and actually placing that trade. So with a cash account. So I think that's something that could be pretty fun. If you guys wanted to hop on trades with me, we could do that together. So let me know what you guys think of that idea. And if you guys are interested in that, want to do a little challenge with me or something, I'm more than happy to do it. But yeah, guys, that's our half hour for this morning. So, if you guys like this video, make sure to subscribe and drop a like on it. I'd really like to get this community growing. Like Nick, for example, really appreciate you getting involved here. I appreciate you recommending a stock for me to take a look at. And by the way, I do this every single morning at 10:30. So let me know if there's anything else you want me to break down. I'll be happy to do it. Every morning I'll be here, guys. All right, that's it for now. Take it easy, everyone.